Good morning, Puan Nuriham. Today, we will be presenting for our Principle of Finance report. We are from Group 3 and our chosen sector was energy.
Good morning, everyone, and thank you for being here. The energy, oil, and gas sector is a massive pillar of Malaysia's economy, but because it's incredibly capital heavy and highly unpredictable, you can't just judge these companies by their surface value. Whether you are investing, lending, or managing, you need to know exactly what is happening under the hood. For this Principle of Finance project, we want to dig more deeper, we analyzed six major players on Bursa Malaysia, which is Baraka Offshore, Petronas Dialog Group, Hibiscus Petroleum, Carimin Petroleum, and Alam Maritime. To get a true picture of their financial health across 2024 and 2025, we evaluate them across four critical areas, which is cash management, asset efficiency, debt levels, overall profitability. After evaluating data and comparing them head-to-head in 2025, one company stood out clearly as our top recommendation. It is Baraka Offshore Petroleum Berhad. They have shown an incredibly impressive turnaround and the kind of resilience you want in a volatile market today. While we acknowledge that historical numbers have their limitations, this data give us a solid, practical roadmap for navigating the sector. Let's see on what we found.
My name is Mutanala Reza binti Jumadir with a metric numbers MC260541578. I would like to explain more about the Petronas Gas Berhad financial ratio. Petronas Gas Berhad is one of Malaysia's top providers of utilities and gas infrastructure. It is a major player in processing, supply and transportation of natural gas throughout Peninsular Malaysia and listed on Bursa Malaysia. Natural gas and commodities are processed, transported and supplied by Petronas Gas Berhad, with a vision and mission, a progressive energy and solutions partner enriching lives for a sustainable future. And for this slide, I would like to explain more about the comparison of Petronas Gas Berhad from 2024 and 2025. Petronas Gas Berhad financial performance show a slight decline in 2025 compared to 2024. The company's liquidity weakened, with the current ratio decreasing from 2.40 times in 2024 to 1.23 times in 2025, and the quick ratio falling from 2.38 times to 1.22 times, indicating a lower ability to meet short-term obligations. In terms of asset management, inventory turnover decreased slightly from 181.69 times to 176.22 times, while receivables turnover improved from 6.80 times to 7.25 times. And for the total asset turnover, have a reducing on 0.35 times to 0.32 times, reducing the average collection period from 52.940 days to 49.62 days. And for this slide, I would like to explain more about the debt management and profitability. For debt management, the total debt ratio increased from 24% to 26%, showing a high reliance on debt financing, while the times interest earned ratio declined from 27.04 times to 21.44 times. And for the profitability, also experienced a small decrease, with the net profit margin dropping from 29.4% to 28.8%, return on asset from 10.2% to 9.27%, and return on equity from 13.8% to 12.9%. Overall, Petronas Gas Berhad remained profitable and financially stable in 2025, but its liquidity and profitability were slightly weaker compared to 2024. And for the next slide, I would like to pass to the next participant.
Now we are going to look at beyond the numbers and tell the story of Baraka Offshore Petroleum Berhad. Baraka is a Malaysian oil and gas service provider. which specializing in pipeline installation and subsea services, trusted by major companies like Petronas and Shell. However, a volatile market of falling oil prices, project delays, and the pandemic hit them very hard, ultimately leading to their delisting from Bursa Malaysia on 4th June 2025. But this isn't a story of a defeat, but it is a story of a pivot. Following the delisting, Baraka immediately launched major restructuring efforts, cutting costs and expanding into renewable energy to build a sustainable path forward. So now let's look at how they managed their finances during this transition between 2024 and 2025. First, the good news is Baraka did an excellent job at protecting their cash reserves, which actually increased from RM 46.26 million to RM 73.06 million. They also cleared up their balance sheet, which their debt ratio dropped slightly to 35.17% and their net gearing ratio drastically improved from a risky 201% to a much safer, which is 93%. The challenge, however, was operational. With fewer projects, their revenue halved, causing their total asset turnover to drop from 0.95 to 0.47 times. In short, they managed their debts and cash brilliantly, but their asset sets underutilized because work dried up. Now, let's talk about profitability, where we see a very interesting paradox. Despite their revenue being cut in half, Baraka's net profit margin actually increased from 31.97% to 35.22%. This is direct result of management's aggressive cost-cutting and restructuring. Of course, because overall net earning dropped, their return on assets fell from 30.32% to 16.50%. Similarly, return on equity fell from 165.38% to 43.72%. While that drop sounds steep, a 42.72% ROE is still incredibly strong, showing that the company remained highly capable of generating positive return for its shareholders even in a crisis. To wrap things up, Baraka's journey is one of resilience. Yes, they lost revenue and faced delisting, but they successfully avoided a big collapse. They trimmed the fat, built up their cash reserves, and significantly reduced their debt. The main hurdle right now is winning new projects. To solve this, Baraka shifting their focuses towards strategic partnerships, marine services, and renewable energy projects. The painful survival phase is over now, and the foundation is very stable. Baraka is ready to rebuild and grow. That's all from me. Thank you.
Hello everyone, my name is Kritika and I will be presenting Charimin Petroleum Berhad. Charimin Petroleum Berhad is a Malaysian oil and gas support services company that is listed on Bursa Malaysia. The company provides services such as offshore support vessels, marine transportation, offshore construction and maintenance services. In simple words, they help support offshore oil and gas operations by making sure everything runs safely and efficiently. Besides that, the company also focuses on providing reliable services while maintaining high safety standards, which is very important in the oil and gas industry. Now, let's move on to the financial ratio analysis. On this slide, I will explain the financial ratio analysis by comparing Charimin Petroleum Berhad's performance in 2024 and 2025. First, let's look at the liquidity ratios. The first is the current ratio, which is calculated by dividing current assets by current liabilities. The current ratio decreased slightly from 1.97 times in 2020 to 1.82 times in 2025. Even though it's decreased, the ratios remain above 1, which means the company was still able to meet its short term liabilities. Next is Q ratio, which is calculated by dividing current assets minus inventory but by current liabilities. Since Charmin had no inventory, the quick ratio is the same as the current ratio. This shows the company still had enough liquid assets to meet its short term requirements. Next, let's move on to the asset management ratios. The receivable turnover is calculated by dividing revenue by average trade receivable. It increased from 18.77 times to 20.33 times, which means the company collected payment from customers faster. The total asset turnover is calculated by dividing revenue by average total asset. It increased from 1 point time to 0.65 times, showing the company was less efficient in using its assets to generate revenue. The average collection period is calculated by dividing 365 days by receivable turnover. It improved from 19.45 days to 17.95 days, meaning customers paid faster in 2025. Now let's move on to the debt management ratios. The total debt ratio is calculated by dividing total debt by total asset. It increased slightly from 0.34 to 0.39, showing the company relied a little more on debt to finance its assets. The times interest earned ratio is calculated by dividing EBIT by interest expense. It dropped from 57.12 times to 4.34 times, which means the company's ability to pay interest became weaker, although it was still able to cover its interest expenses. Finally, let's look at the profitability ratios. The net profit margin is the net profit margin is calculated by dividing net profit after tax by sales and multiplying by 100%. It dropped from 13.79% to 0.74%, showing the company earned much lower profit from its sales. Next is return on asset. It decreased from 13.79 percentage to 0.48 percentage, showing lower returns from the company's assets. Lastly, the return on equity fell from 20.35 percentage to 0.75 percentage, showing lower returns for shareholders compared to the previous year. Overall, Charmin Petrol Berhad maintained good liquidity, but its asset management and profitability declined in 2025. Thank you.
Hi everyone, my name is Durgashwari and I'm going to present about Hibiscus Petroleum Berhad. I will introduce the company and will explain about its financial performance based on financial ratios. So, let me start with the background of the company. Hibiscus Petroleum Berhad is Malaysia's first independent listed oil and gas exploration and production company. The company was established in 2011 and is listed in Bursa Malaysia. Its main business involves the exploration, development, and production of crude oil and natural gas. The company also operates oil and gas assets in several countries, including Malaysia, Vietnam, Australia, and the United Kingdom. Overall, Hibiscus Petroleum focuses on creating long term value through efficient operations, sustainable growth, and responsible energy production. Now, let's move on to the company's financial ratio analysis. Next is financial ratio analysis. This table shows the financial performance of Hibiscus Petroleum for 2024 and 2025. First, looking at the company's liquidity, we can see that the current ratio decreased from 1.48 in 2024 to 0.80 in 2025. The quick ratio also decreased from 1.36 to 0.71. So, this shows that the company's ability to meet its short term financial obligations became weaker in 2025. Next, looking at the company's efficiency, the inventory turnover remained quite stable with the only a small decrease from 5.05 times to 5.02 times. The total asset turnover also decreased from 0.42 times to 0.33 times. This suggests that the company was slightly less efficient in using its asset to generate revenue in 2025. Moving on to the company's debt positions. The total debt ratio remained the same at 0.64 times in both years. However, the time interest earned ratio decreased from 7.91 to 3.3 3.63 times. This shows the company's ability to cover its interest expenses became weaker. Lastly, looking at the profitability, we can see a clear decrease. Net profit margin margin dropped from 17.20 percentage to 5.04 percentage. The return on assets also decreased from 7.30 percentage to 1.67 percentage, while the return on equity decreased from 19.67 percentage to 4.63 percentage. So, overall, based on the ratios, we can see that Hibiscus Petroleum performed better in 2024 compared to 2025, especially in terms of liquidity, efficiency, and profitability. However, when we use financial ratios to evaluate a company, we should also understand that that there are some limitations.
So, my name is Danusha Grazer Anak Perempuan Kanagarajan, and today I will be presenting the financial ratio analysis of Alam Maritime Resources Berhad, or better known as AMRB. The Alam Maritime Resources Berhad is a Malaysian investment holding company that was established in 1998 and is headquartered in Bandar Baru Sri Petaling, Kuala Lumpur. The company has been listed on the main market of Bursa Malaysia since 20 July 2006. AMRB mainly provides offshore support services to its oil and gas industries. Its core business activities include marine transportation support services, marine construction related services, subsea engineering, offshore pipeline installation, remotely operated vehicle or ROV services, as well as ship repair and maintenance. These services mainly support upstream oil and gas exploration and production activities. The company's vision is to become the preferred offshore service partner in the oil and gas industry. Meanwhile, its mission focuses on delivering quality offshore services while maintaining high standards of health, safety, environmental protection, and corporate governance as well as creating long-term value for its stakeholders. Now, on this slide, I will present the financial ratio analysis based on the company's financial statement of the year 2024 and 2025. Firstly, I will touch on the liquidity management ratio. The current ratio is calculated using the formula current asset divided by current liabilities. In 2024, the current ratio was 0.61 times and it increased to 0.76 times in 2025. Although it improved, the ratio is still below 1. This means that the company still does not have enough current asset to fully cover its short-term liabilities, but its liquidity position became slightly better compared to the previous year. Next is quick ratio, and the formula is current assets minus inventory divided by current liabilities. The quick ratio increased significantly from 0.39 times in 2024 to 0.74 times in 2025. This shows that after excluding inventory, AMRB had more liquid assets available to pay its short-term obligations. Overall, the company's short-term liquidity improved. Next is asset management. The first ratio is inventory turnover, and that is calculated by dividing cost of sales to average inventory. The inventory turnover increased sharply from 4.27 times to 71.79 times. This indicates that the inventory was sold or utilized much more efficiently in 2025. Next is receivable turnovers, and the formula is net credit sales divided by average trade receivables. The ratio increased from 6.93 times to 18.50 times. This means that the company collected payments from customers much faster than before. For the total asset turnover, the formula is sales divided by average total asset. The ratio increased from 1.35 times to 2.29 times, showing that the company generated more sales from every ringgit invested in assets. Finally, average collection period is calculated by dividing 365 days to receivable turnovers. The average collection period improved significantly from 52.67 days to 19.73 days. This means that customers paid much faster in 2025, resulting in better cash flow. Moving on to the debt management. The total debt ratio is calculated using total liabilities divided by total asset. The ratio decreased from 134% in 2024 to 124% in 2025. Although there was an improvement, the debt ratio remains above 100%, indicating that the company's liabilities are still higher than its total asset. The second ratio is times interest earned ratio, and the formula is EBIT, or earning before interest and tax, divided by interest expenses. The ratio increased from 6.49 times to 11.41 times. This shows that AMRB became more capable of paying its interest expenses from its operating earnings. And lastly is profitability. The net profit margin is calculated using net profit divided by revenue times 100%. The margin decreased from 15.39% to 9.11%, meaning that the company earned less profit from each ringgit of sale despite generating higher revenue. The ROA, or return on asset, uses the formula net profit divided by average total asset times 100%. The ROA remained almost unchanged at 20.8%, indicating that the company continued to utilize its asset efficiently to generate profit. And lastly, the ROE, or return on equity, is calculated using net profit divided average shareholders' equity times 100%. The ROE changed from negative 62.05% to 87.81%. This negative ROE indicates that the shareholders' equity remained negative, suggesting that the company still faced accumulated losses and financial challenges despite improvement in operational performance.
Hi, my name is Muhammad Izzat Lufi, and for this slide, I will be presenting the company called Dialog Group Berhad. So, firstly, Dialog Group is a Malaysian integrated technical service provider that mainly serves the energy sector. The company was established in 1984 and has expanded over the years through strategic partnerships and also regional growth. Its operations cover the full energy value chain, including the upstream, midstream, and downstream segments of the oil and gas, petrochemical industries. Its main business activities include engineering, procurement, and construction, as well as plant maintenance, fabrication, specialist technical services, and terminal ownership and operations. Besides its traditional oil and gas activities, Dialog Group is also expanding into a sustainable and renewable energy-related business. Overall, the company focuses on delivering safe, reliable, and efficient solutions to support the energy industry. So this slide presents Dialog's group financial ratios in For the financial years 2025 and 2024, the ratios are divided into four categories, which are liquidity, asset management, debt management, and also profitability. Starting with the liquidity management, the current ratio decreased from 2.52 times in 2024 to 1.46 times in 2025, while the quick ratio declined from 2.43 times to 1.41 times. This shows that the company's ability to meet its short-term obligations weakened into 2025. However, both ratios remain above 1, meaning Dialog Group still has sufficient liquid assets to cover its current liabilities. Next is asset management. The inventory turnover increased from 28.50 times to 30.50 times, showing that inventory was managed more efficiently. The receivable turnovers also improved from 4.65 times to 6.20 times, while the average collection period decreased from 78 days to approximately 59 days. This means the company collected payments from customers more quickly. However, the total asset turnover decreased from 0.35 times to 0.29 times, indicating that the company was less efficient in using its total assets to generate revenue. Now moving into debt management ratio, the total debt ratio decreased slightly from 28.26% to 27.58%. This is a positive sign because the company relied slightly less on liabilities to finance its assets. However, the time interest ratio fell from 11.48 times to 8.70 times. Although its ability to cover finance costs weakened, the ratio remained high, indicating that Dialog Group could still comfortably meet its interest obligations. To meet its interest obligations. Lastly, for profitability, all three ratios declined. The net profit margin decreased from 19.21% to 12.38%. Return on assets declined from 6.67% to 3.59%, and the return on equity ratio fell from 9.67% to 5.29%. This means that the company generated less profit from its revenue, assets, and shareholders' equity in 2025. Overall, Dialog Group remained financially stable with sufficient liquidity, relatively low debt, and adequate interest coverage. Nevertheless, its overall performance weakened in 2025, mainly because of low profitability, reduced liquidity, and weaker total asset utilization. Now on the slide, you can see the comparative analysis table by comparing all the financial ratios with other companies such as Petronas, Baraka Offshore, Caribbean Petroleum, Hibiscus Petroleum, Alam Maritime, and Dialog Group.
And now for part 2, I will talk about the comparative analysis table. This table compares all of the 6 other companies in the same industry based on their financial ratios. Starting with liquidity, Chariman Petroleum recorded the highest current ratio and quick ratio of 1.82 times, followed by Baraka Offshore at 1.59 times. These companies are stronger positioned to meet their short-term obligation compared with Alam Maritime, which recorded 0.76 times and 0.74 times respectively. For asset management, Alam Maritime performed very well by recording the highest total asset turnover of 2.29 times, showing its used assets most efficiently to generate sales. It also had the average collection period of 19.73 days, meaning that it collected payments from customers the fastest. However, Petronas Gas achieved the highest inventory turnover of 176.22 times, indicating very efficient inventory management. Moving on to debt management, Chariman Petroleum had the lowest total debt ratio of only 0.39 times, while Alam Maritime recorded the highest at 124 times, showing that it relies heavily on debt financing. For the times interest earned ratio, Petronas Gas performed the best with 21.44 times, meaning it had the strongest ability to cover its interest expenses. Lastly, in terms of profitability, Baraka Offshore stood out as the best overall performer. It recorded the highest net profit margin of 35.22 times, a strong return on assets of 16.50%, and the highest return on equity of 43.72%. These results show that Baraka Offshore was the most profitable company, generated from the best returns of both its asset and shareholder investment. Overall, although Alam Maritime showed strong efficiency in managing its assets and collecting receivables, Baraka Offshore demonstrated the strongest overall financial performance because of maintaining good liquidity, strong profitability, and healthy returns, making it the best performing company among the six companies that we compared.
And for the investment recommendation, I believe that the best, sorry, I believe that the best strong investment for us to invest in is Baraka Offshore. Why Baraka Offshore, you say? Well, the first point that I can give is the stronger profitability. Baraka Offshore has the highest net profit margin at 35.22%, showing that it earns more profit from every ringgit of sales compared with other companies. It also records a strong return on assets of 16.50% and liquid equity of 43.72%, indicating efficient use of assets and good returns for shareholders. And the second reason is acceptable financial safety. With its acceptable liquidity and debt paying ability, its current and quick ratios are both 1.59 times, meaning that the company has enough current assets to cover its short-term liabilities. Its time interest earn ratio of 9.44 times also shows that it can comfortably pay its interest expenses from operating earnings. So in conclusion, Baraka Offshore provides a good competition of high profitability, strong shareholder returns, and acceptable financial stability. Therefore, it is the preferred investment choice based on the ratio provided. But you might be thinking, why Barca Offshore and not Petronas, since Petronas' current and quick ratios are also low? While you can say Petronas is a strong investment choice, especially for a more conservative investor, we believe that Barca Offshore was like we believe that we will choose Barca Offshore because it provides better combination of liquidity and profitability based on the comparative ratio table just now. Baraka's current and quick ratios are both 1.59 times compared with Petronas at 1.23 and 1.22 times. Both companies can cover their short-term liabilities because their ratios are above 1.0, but Baraka has a larger liquidity buffer. More importantly, Baraka records a higher net profit margin of 35.22%, ROA of 16.50%, and ROE of 43.72%, compared with Petronas' 28.8%, 9.27%, and also 12.9% respectively. This indicates that Baraka generates a stronger profit and higher returns from its assets and shareholders' funds. However, Petronas is financially safer because it has lower debt ratio of 26% and a much higher interest coverage of 21.44 times. Therefore, Baraka Offshore for us is preferable for investors seeking higher returns, but Petronas is only preferable for investors prioritizing financial stability and lower risk. So based on the ratios provided, Baraka Offshore is chosen because its stronger profitability outweighs its slightly higher financial risk. Thank you.
Lastly, we are going to look at the limitation of financial ratio analysis. The first limitation is the financial ratios do not explain the reason behind the numbers. For example, a ratio can tell us that a company's performance has increased or decreased, but it cannot tell us exactly why it happened. The change could be due to inflation, market conditions, competition, operating cost, or even management decisions. So, we should not depend only on financial ratios. We should also look at the other information provided in the company's annual report. The second limitation is that financial ratios ignore non financial factors. For example, ratios do not measure things like customer satisfaction, employee performance, product quality, brand reputations, technology, or innovations. Sometimes a company may have weaker financial ratios because it has invested more money in new technology or employee trainings. Although this may affect the company's financial performance in the short term, it could actually help the company perform better in the future. So, to conclude, financial ratios are useful for understand and comparing a company's financial performance, but they do not give us the complete picture. We should always consider both financial and non-financial information when evaluating a company. That's all from me. Thank you.
Lastly, based on our financial ratio analysis, our group recommends Baraka Offshore Petroleum Berhad as the best company to invest in. The company showed strong profitability and a stable financial position in 2025 compared to other companies analyzed. Through this assignment, we learned that investors should not depend on only one ratio when evaluating a company. They should consider different aspects such as liquidity, debt management, asset management, and profitability before making investment decisions. Overall, this analysis helps us to understand how financial ratios can be used to compare and evaluate a company's financial performance. That's all from us. Thank you.